Let's talk bonds now. Stephen Nash from FIIG Securities with me in studio. Stephen, a warm welcome to the show. We had consumer prices yesterday. Interesting, because we had headline numbers and underlying ones which point almost in opposite directions. Which one do you look at and why, and how did the bond market react?
Well, I think the bond market was looking at a possibly good figure because the RBA minutes the day before had left the door open for further easings in policy, so the market was looking for maybe lower numbers which would then allow a possible easing. But what happened is effectively the opposite, where we got a high underlying number which wasn't really very positive for the possibility of an easing. I imagine that the possibility of the easing is still there. The RBA, like the Fed, are being very cautious. They've had to do a lot of the work in the last few months, and they've seen the extent of this slowdown and the panic that's been in markets. So I think they're remaining very cautious. And
it seems to be that unemployment is very much the watchword. We heard overnight with Bernanke talking about this, still the #1 concern there.
Yeah.
In the back of the RBA's mind, we know from past recessions, not that we're in one at the moment, but they have always used that as a bit of a touchstone for moving on rates. How does iTraxx look at unemployment as a signal, as a concern, of anything, about default rates?
Well, the iTraxx at the moment has been very strong. It's been contracting. We had a little bit of a blight, but it's come back in. Demand for credit in terms of the underlying markets has been very strong of late. There seems to be a bit of an allocation towards credit.
How do you account for that? Because is the market really not believing that unemployment will spike, and that will perhaps put really the economy at risk?
I think there's been a lot of short covering in credit markets. Partly that's brought that spread right in. There's also been a perception that people have missed out in the sense that people are chasing the market to some extent at this time. It's very much to do with the recovery in underlying equity markets. The optimism that's been evident in the last quarter is just basically fed into the credit markets, probably a little bit too much at this stage.
Well, because we've got $100 billion worth of bonds coming up for auction in the United States very shortly. That almost gives the lie to the. Well, I mean, we know there's that much that has to be recovered. I mean, the spending is out there, so we know that. Is this just the continued trickle through on these auctions?
If you look at the medium-term forecasts, we've done some work on that, and that indicates that the current elevated level of government supply is going to continue over the next few years. So that means supply is more than double in terms of on a monthly basis than what it has been in the last few years. There are implications in the sense that if supply is double, there is going to be some sort of, at some stage, some difficulty in selling those securities, one would imagine. Yeah. So,
well, the prices. I mean, that old expression: "There's always a price. There's always a buyer at the right price." Yeah. So the yields will just have to go higher.
Yeah, well, as you know, the market seems to go in waves in terms of optimism and pessimism. When the Fed came out recently and said that that they'd have accommodative policy for quite a while, the market reacted very positively to that, and that can still happen. But this underlying supply issue is there, and that there could be an argument for governments to consider demand stimulus measures for government securities.
Specifically, how is that? How would that work its way through the system?
Well, there could be more regulation in terms of requiring banks to own government securities. There could be more asset liability management, more in terms of superannuation funds, more conservative restrictions on what people can invest in terms of equities, more age-based, possibly investment solutions for people, so that older people have more fixed income and less equity.
Do you believe there is the will to do that at the moment? It seems that even the ratings agencies in the US are not going to fall under the regulator's heavy-handed watch, if the latest reports are to be believed.
Well, look, at this stage, I'd probably say that governments are reluctant to do anything at this stage, but it's a medium-term issue, and I think there should be some thought put into it. Yeah.
Who would be the first to blink? Because people are now talking about Europe as being the real laggard. Are they the ones that could surprise with heavy-handed regulation as opposed to the United States?
It's a possibility that Europe could lead, yes, because there's a lot of supply there. UK in particular have a lot of supply going forward. The US obviously have continuing issues with supply.
Can we move on? Can we talk also now about the federal government back here and their deposit guarantee? When should that end? when must it end in order for smaller players to believe they have a stake in this market?
Well, I think at this stage, I'd probably agree with the RBA and keep fairly cautious. So I'd be arguing to maintain that guarantee for the time being.
Based on what? Well, their caution is predicated on what are they looking at?
Well, in the sense that we have an underlying problem with consumer balance sheets, and the market's quite fragile in terms of, as other people have recently indicated, some of the people from the major banks have indicated the outlook's quite fragile, and probably agree with that. A lot of small companies have difficulty finding finance at the moment. That could lead to further unemployment, and things could change very quickly. So we need a direction, and we need the government to provide that, I think.
If you look to the UK overnight, some are saying a full recovery won't happen until 2014.
Yeah.
Now, if you left a guarantee in place for that long, what would it mean for smaller competitors?
Well, I think for smaller competitors, particularly in the Australian market, they're getting a bit squeezed at the moment in terms of their profit margins. So there could be an argument to moderate the difference between the guarantee charge for lowly rated banks versus highly rated banks. I think there could be an argument to maybe squeeze that in a bit, so that they can make those smaller institutions more profitable, and then increase competition in the banking market. The recent financial crisis has strengthened the position of the major banks, and I think there's an argument to possibly try to level that out a bit. Sure.
A level playing field, as they say. Stephen, we must leave it, but we'll see you again sometime soon. Many thanks.
Thanks very much.
Stephen Nash from FIIG Securities.